Welcome to Accounting Fundamentals Module 2, Constructing an Income Statement. In this module, we have several objectives. The first one is to explain the format of the income statement and its composition. Then we will learn how to record transactions. Finally, based on those transactions, we will be able to prepare a simple income statement together. Let's jump in and get going. Now let's move on to look at the income statement. The income statement can also be referred to as the Statement of Operations, or the Statement of Profit and Loss, which is sometimes shortened to P&L. When you think about all of the transactions that a company records during a period, you can see why it's necessary to have a statement that's dedicated just to the operations of the business. While in theory it could be possible to record everything on the balance sheet under retained earnings, we realize that really it requires its own statement to keep track of all of the income, all of the expenses, and all of the resulting profits or losses. Let's look at the income statement in more detail. The income statement starts at the top with revenues. Revenues can also be called sales or turnover. It represents the income that a company receives for selling goods or services. Below revenues, we have direct operating expenses, such as purchasing inventory. This line is often called cost of goods sold or cost of sales. This is the first expense line on the income statement. After deducting cost of goods sold from revenue, we arrive at our first subtotal on the income statement, referred to as gross profit. Gross profit is equal to revenue minus cost of goods sold. If we take the gross profit and divide it by the revenue, we calculate the gross profit margin. Whatever remains as gross profit can be used by the company to cover its indirect operating costs. Next on the income statement come the indirect operating costs. These include things like research and development, administration, selling, and distribution. Several of these line items may be grouped into one, sometimes called Selling, General, and Administrative Expenses, SG&A, or just General and Administrative Costs, G&A. If we take revenues and deduct the direct operating costs and then deduct the indirect operating costs, we arrive at the next subtotal, operating income. The terms profit or earnings can be used interchangeably with income. Operating income is often referred to as EBIT, which stands for EBIT, earnings before interest and taxes. Below the operating income line on the income statement, we can then deduct the cost of debt financing. This includes interest expense and bank charges. After deducting the cost of debt finance, there is often another subtotal for earnings before tax. Below that, taxes are deducted, and finally, we arrive at net income, the bottom line. Net income can also be called net earnings or net profit. This is the bottom line of the income statement, which then feeds into the retained earnings account on the balance sheet. Now, let's create a full income statement using our previous balance sheet example. On the left, you see an extract from a balance sheet in the previous section. All of the items that we are going to track on the income statement will ultimately combine to create the account that flows into retained earnings, which is net income. We start building the income statement by first adding in the total revenues of 90, then deducting the cost of those sales, that is the direct cost of 60. And from there, we arrive at the subtotal of gross profit of 30. Next, we're going to deduct all other operating expenses. As you recall from the earlier example, the only expense we had in this simple example were salaries of 20, so we will deduct those. As we mentioned earlier, all other indirect operating expenses may be referred to as SG&A or simply G&A. After netting out the salaries expense, we arrive at the operating profit subtotal of 10. Finally, we deduct the interest expense of 3 and the tax bill, which in this case is assumed to be 0. The resulting net profit after deducting these final expenses is 7. And 7 is what flows back onto the balance sheet as retained earnings. You can see why the separate income statement is absolutely necessary, as it would be near impossible to track all of this under the retained earnings account on the balance sheet. Let's look at recording income and expenses on the income statement. It's important to note that the income statement only includes the revenues and the expenses that relate to that accounting year or fiscal year. So, as an example, if during the last month of the fiscal year, the company buys an insurance policy for 12 months and at a cost of $12,000, the question is how much insurance would be included on the income statement for this accounting year. Since the insurance policy was purchased for 12 months, the cost of that insurance policy should be smoothed out over the course of the period. Starting in month 1 and ending in month 12, it equates to $1,000 per month as the cost. So, given that 1 month of insurance costs $1,000, only $1,000 would be recorded on the income statement in that year. But the question is, what would happen to the remaining $11,000? Well, the remaining $11,000 would go on the balance sheet. It would be an asset, which is a prepaid expense. And because that prepaid expense is expected to be used within a year, it would fall under current assets. Anytime prepayments are made, or anything, they result in an asset on the balance sheet known as prepaid expenses. So, to summarize, since the insurance policy was purchased with only 1 month left in the year, instead of recording an expense on the income statement of $12,000, an expense of only $1,000 is recorded, and the remaining $11,000 goes on to the balance sheet as a prepaid expense. Here is another example for us to look at. Imagine that a company used $2,000 worth of office supplies in the current year, but did not pay any cash for them until the following year. The question is, how much of this expense should be included in the income statement for the current year? The answer is that the company should include the full expense of $2,000, as this is the value that was used in the year. But then the question is, since the company didn't actually pay for the office supplies in the current year, how do we record this second half of the transaction, which is the amount owed? The answer is we record it as a current liability on the balance sheet. The amount is called an accrued expense. It is recorded as a current liability because we will have to pay the expense within the next year. So, in summary, accrued expenses are expenses that have been reflected on the income statement but have not yet been paid for. They will go on the balance sheet as an accrued expense. Now let's cover depreciation expense. Recall from our balance sheet example that we purchased equipment of 80. This equipment of 80 was recorded as a non-current asset under the heading Property, Plant, and Equipment. Now, let's assume that the useful life of this equipment is 4 years. Let's also assume that we could allocate the usefulness of this equipment evenly over 4 years. And additionally, at the end of the 4 years, it will have a scrap value or salvage value of 30. So the question now is, how would we account for the reduction in value of the equipment as it's used in our operations? Well, the answer is that we would record an expense called depreciation that would spread out the cost of this equipment over its useful life. Let's look at depreciation in more detail. On the income statement, we record a depreciation expense. We calculate that expense by taking the purchase price of the equipment subtracting the scrap value at the end of its life and dividing it by the number of useful lives that it has. When we make that calculation, the result is a depreciation expense of 12.5 per year for 4 years. This is what will be recorded on the income statement for each of the 4 years that the asset is depreciated. But this is only half of the equation. Now let's take a look at what happens on the balance sheet. On the balance sheet, we have to record a property, plant, and equipment balance. In order to record the balance, we take the initial purchase price, reduce it by the depreciation expense, and we get the closing balance that will go on the balance sheet at the end of the first year. Then in the second year, we start where we left off the prior year. We again deduct depreciation expense of 12.5, and we get a closing balance in year 2 of 55. In year 3, we follow the same pattern, taking the prior year ending balance, subtracting the depreciation expense, and getting this period's closing balance, 42.5. Finally, in the last year, year 4, when we deduct depreciation, we arrive at the scrap value of 30. That means that from here on out, if this asset remains on the balance sheet, it will stay at 30 and not go lower. If it is sold in the future for any value, then it will be removed from the assets of the balance sheet. So, in summary, the day the asset is purchased, it goes on the balance sheet at the purchase price of 80. It's then reduced over the period of 4 years by 12.5, which is the depreciation expense each year. Finally, it ends at a salvage value of 30.